I want to talk about the bootstrapping because so far on this show, I think I've had, 3 or 4 people who've bootstrapped. And those are some of the most popular episodes. I think it's also becoming something that more and more people are looking at doing. I think as like from a trend perspective right now. So I just want to, from the beginning, when you were the three of you were starting the company, did you say to each other, "We are going to bootstrap this business"?
Well, it was a mixture of both. I mean, we did. I'll say we raised 400,000 in angel money, and it was a little more than friends and family. It was local professional angels, um, but not VC firms or sort of the rest. I mean, these were individuals. Um, we also I saved for a year and a half because I knew I wasn't going to pay myself for a year, right? And I took the last year. We gave our prior company a year's notice that we were going to leave and do this. It was about like 9 months. And we offered them a chance to invest, but we also, knew that they needed time to build a team around us.
Right.
And so we just said, if we stay to the end and we earn our bonus, I'm going to live off that bonus for a year, right? And so we didn't pay ourselves for the first probably 18 months of this. Like we worked really hard. We saved all of the money that we could to get there, raised 400,000, but used that into hiring some early folks. It kind of went from there.
And so you did you go out to fundraise, post that 400,000 investment, um, or like, or was that like we're taking 400,000, we're not taking salaries for 18 months, and we're just gonna bootstrap this? Like, mentality wise, like what was the
We
mentality?
started having conversations with VC firms, and we were looking to raise. Uh, I will say the early indications were very much, like we were starting a B2B media company targeting the electric utility industry at a time when BuzzFeed was getting hundreds of millions of dollars to do social, right? And so the media investors sort of looked at us and said, "You're doing digital lead generation in the waste and recycling and utility industries." And like, so we knew, like, we recognized early on it was going to be a hard road. We also got some sort of, not firm, but preliminary term sheets from folks. And we just thought, wow, this doesn't recognize where the business is. And if we could hold on for another 12 months, this business will look a lot different, and we can go raise then on entirely different terms. And so we took out a little bit of debt, and support from our angels. When we got to the point 12 months later, the business had grown enough that we were throwing off cash, and we decided we don't like, why do we need to why do we need to bring in a VC firm, raise a bunch of money when the business is cash flow positive and we can invest, like we're investing money back into the business at that point. And so we kind of, you know, a little bit luckily and a little bit intentionally skipped the whole VC standpoint. It got to the point where, we had healthy EBITDA margins. The business was growing, 20-30% annually. And we got it to I would say in our industry, you want to be sort of north of 20 million top line and 5 million EBITDA. And then the private equity guys really start to get excited about you. Right. And so we got to that point and skipped right to private equity.
And what would you have done differently if you were able to raise, if you had gotten a good term sheet, you were able to raise, what do you think you would have done differently in the business? Anything?
You know, Maybe. I mean, I think there's like a part of this is you have to recognize where you are and the rest. I was always one of these guys pushing for our business to be profitable. Like I just like, like I just sort of said like this is to be self-sustaining, like we need to be profitable. We need to like be able to do the rest. And so I don't know if I might have had a hard time with the VC mentality of like, no, 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 go big. Let's lose a bunch of money for the next 4 years and sort of scale this. And I honestly think, in some industries, software, that probably makes a lot of sense. In the media industry, I don't know if VC is actually the right financial vehicle for it because in
Mm,
the early days, the most important thing for a media company is to build an audience and to build a real audience, not sort of traffic from a social network or flyby SEO. It's to build people who have an affinity with your brand and you. And that's a little bit like pregnancy, and you can't hurry it, right? And so I think there's this misalignment where VC comes into media industries and tries to accelerate something that needs organic time for itself. And so that more than anything, I think was what we got really lucky with is we didn't hit these, artificial constraints where we're trying to grow it, grow an audience, and what you end up growing is traffic, but not like loyalists.
mm. That is a really interesting point. It makes sense. Like from a media perspective, if you were an investor, like you need volume of followers or audience or whatever it is, and you can spend to get it, to your point, but that's not going to be real. Like that's not, and I get
It's a
that where
sugar
you,
high, it's a total
yeah,
sugar high that doesn't last, and you need to really kind of have the balanced diet.
and that just doesn't work. I mean, that is not in the venture model, really.